if you're massively long bonds and bond proxies in intractable inflation, you're gonna get crushed. And if you're massively long high beta risk assets in deflation and recession, depression, you're gonna lose. Your retirement is gonna be thrown into the fire. So it's very crucial you understand these dynamics.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 17th through January 24th, 2023, while supplies last. This week we feature our choice 10-ounce silver bars at just $2.25 over spot per ounce and backdated quarter-ounce Canadian maple scruffies at only 4% over spot. Frequently, you have to choose between high-volume bars like 1,000-ounce bars to get exceptionally low premiums, or pay a higher premium for more liquidity. But these Our Choice 10-ounce silver bars come from major mints, are 3/9 fine, and provide a great way to stack quickly while maintaining a high degree of liquidity, all at the low premium of just $2.25 over spot per ounce while supplies last. Next, we have quarter-ounce gold maple scruffies at 4% over spot. The Royal Canadian Mint packages quarter-ounce maples in sheets, which most people find inconvenient for storage, trade, or transacting, so they frequently remove them and put them in individual flips or in tubes. As soon as the packaging is removed, they go from being considered brilliant uncirculated to what is called scruffy condition. They may occasionally have a nick or scratch, but by and large are in excellent shape and nearly indistinguishable from their brilliant uncirculated counterparts. And the best part is that these so-called scruffy coins are available at just 4% over spot, much less than the 10 to 15% that you would ordinarily pay for the increased liquidity of quarter-ounce gold. So if you'd like to purchase 10-ounce silver bars at just $2.25 over spot, quarter-ounce Canadian maple scruffies at only 4% over spot, or if you'd like to inquire about any of our other products or services, call us at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this returning guest. Michael Pento of Pento Portfolio Strategies is an active money manager. He joins us this Tuesday, January 17th, 2023. Michael, thanks for coming back on Liberty and Finance.
Thanks for having me back on, and I can hear you're a little under the weather, so I hope you feel better soon.
Yeah, we were quite blessed that through extensive travels over the past 2.5 months, we were protected. We didn't catch anything on those travels, but after we got back home, we were unwinding, and that's when I finally came down. Now my wife's coming down with it too, what I came down with. So we'll muddle through, but anyway, thanks everyone for bearing with us. And we don't usually we usually put out a call for questions from viewers for our guests, and I missed it this time, but I've asked Michael about some of his latest research because we're in very eventful times financially, and as our channel has always focused on preparedness and awareness, we are trying to help everyone who watches this channel be aware and prepared of how they can protect their family's financial future so that they can survive and thrive in the coming changes. And we've talked a lot with you, Michael, about the volatility that we can expect. There are so many opposing forces that are pressing towards inflation, deflation. Which way are geopolitical events going to spin this chaos that's going on around us? But we'd like to zero in on a couple of topics. One that you mentioned when we were speaking was about China, and that's certainly been in the role in the discussion of a lot of people recently, talking about their role in not only geopolitical events but also a major financial force rising in the world and spreading their influence far beyond their borders. So could you talk to us about what you've been researching about China and their impact on what's going on now and what you see going forward?
Well, as you might have heard, the news, China is reopening a little bit earlier than predicted. I think they were supposed to start reopening in March. They started in early January, which I think is the major catalyst for this recent rally. And I got to thinking about China. First of all, I don't believe anything that comes from this communist nation's mouths. And this is not an indictment of the people of China. This is an indictment of the leadership of China. So China came up with some statistics of late. So first of all, you should know that China claims that in 2022, which was now last year, I get that wrong. Their economy grew by 3%. And I said to myself, wait a second, how is it possible that China's growth increased. It grew. The economy grew, even though they locked down the entire nation practically. You couldn't go outside. People were limited into where they could travel, and they had to be sequestered in their work environment. And then this is two things I want your audience to understand. First of all, China's population is now decreasing for the first time since like early 1960. And, oh, gee, well, you kill off half the people that are born, and you wonder how come your population shrinks. And then you also have to understand that the labor force has been shrinking for years. Why is that important, Mr. Pento? Well, I'll tell you. So half of GDP growth comes from an increase in the number of people in the labor force. Now, that can come from a couple of ways. People, immigrating and starting to work, or from organic population growth. But none of those things are happening. The labor force is shrinking and the population growth is shrinking. So the other half of GDP growth is productivity. So what China is now claiming is that people have been so much more productive in their homes that it actually offset the decline in the labor force from 2020. Now, can you possibly believe that? Now, and if you do believe that, if you do think China became a more productive nation when people were locked in their houses, then I guess letting them out of their houses is going to lead to a decline in productivity. So, what I'm trying to say here is that two things. Don't trust the numbers from China, A, and B, if you do trust the numbers from China, then the end of their lockdowns is not going to certainly bring the global economy out of the inexorable recession that it's heading for.
Besides not trusting the data that you see issued by the Chinese government as far as their financial health, what other observations have you been making in your study of the impact that China's been having, or you expect it to have ongoing on the world economy?
So we had a very good rally the first 9 trading days of 2023. And I think that's primarily predicated on the fact that the US dollar dropped about 10% now since September. And of course, when the dollar drops, you get an increase in risk assets, commodities, earnings of multinational corporations tend to do better. So let's look at why the dollar is dropping and if that's going to continue. So Europe, the European Union's largest trading partner is with China. And I believe that China reopening is going to be better for Europe, or at least not what I believe. Not even my kids sometimes. It's what the market believes is going to happen, is that China's reopening is going to be better for Europe, the European Union, thus better for Europe, which brings the dollar down. The other thing that's, the giant elephant in the room is that CPI, inflation, dropped from 9.1% in the summer all the way down to 6.5% in the latest reading. So that's disinflation. Now, I predicted this. I knew it was going to happen. I explained why. And you have to look no further than the fact that the monetary base is now shrinking very rapidly, base money supply, reserves in the banking system. That's how they make loans. They need reserves against those loans. It's the law, Basel III. And also M2 money supply is shrinking. So you don't have to be a super genius. You just have to be someone who's objective, looks at the arcane things in the market, such as base money supply and M2 velocity and actual supply, and you understand that we are disinflating. And the other thing, let me just finish that second point. Disinflation would be something that I think would tend to let the Fed be less aggressive on its monetary policy, which is, in the short term, dollar friendly. In other words, it's negative for the US dollar. Now, the third thing is that, and this is what I find most shocking, Japan, the Bank of Japan, is actually threatening to remove yield curve control completely. Now, let's just look at the Japan dynamics for a second. Japan is a nation that has over a quadrillion yen in outstanding debt, 225% debt to GDP. And their inflation is going to 4% and higher. It's going much higher, 4% core inflation in Japan. And in that context, Japanese government bonds, JGBs, going out 10 years, yield 0.5%. Now, if they were silly enough, had the temerity to remove completely yield curve control, and that's what, this is not what I'm theorizing, there's a Wall Street Journal article about it, Bloomberg's talking about it, that the Bank of Japan tomorrow might remove completely yield curve control. That would send yields skyrocketing, not only in Japan, but across the globe. That would be very bullish for the Japanese yen and put more weakness on the dollar. So short term, we had those three things I talked about. So CPI, disinflation, China reopening, very bullish for Europe, and perhaps the end of yield curve control in Japan, all very negative for the dollar vis-a-vis other foreign currencies, which has caused this 4% move higher in the S&P 500. And I don't think any of those things I just mentioned are going to last very long. I think the dollar is going to have at least in the short term, in the intermediate term, not the very short term, intermediate term, it's going to rally. And the reason why I think it's going to rally is because in every other instance of a global recession, and that is exactly where we're headed, the dollar has seen that it enjoyed a bid. And that's exactly what I see happening in the Q2 all the way through the next following few quarters.
So how does that affect the other things that you've talked with us about, interest rates in the U.S., real interest rates, and precious metals prospects for the rest of 2023?
So just to review, so I'm an active trader. Okay, I have an active strategy, the inflation, deflation, economic cycle strategy. So some people say sometimes they hear me on an interview and I'm 5% long the precious metals complex, and then other times I'm out completely, and other times I'm up 20% long. So it varies. As of right now, and as of recently, the past few months, up until this point, I've been long physical metals, physical gold, around 8%, 7-8%, and I've been trading the miners. Miners are to be traded on pullbacks. But as far as a secular bull market in the miners are concerned, I'm going to need to see a genuine capitulation on the part of Jerome Powell. And I don't see that happening anytime in the near future. And when you add into the fact that there is a risk that Japan could, and I think it's a very small risk, as I just laid out, but if Japan actually relaxes yield curve control, say they just raised the cap from 0 to 25 basis points all the way to 50 basis points. So it's a double. It's not much, but it's a double. If they were to, say, go to 1%, that would drag yields up in Japan and across the entire globe higher. And higher nominal yields also would lead to a rise in real interest rates. And that is, it's always been the bane of gold. So that's what I'm worrying about. Of course, to offset that a little bit would be the fact that the dollar would be weaker. So you have to, that's why I'm here every day, measuring and mapping all of these dynamics. But don't lose, if you're not a trader like me, don't lose sight of the trend. The trend is for disinflation, deflation, a general economic malaise, recession in 2023. That's generally dollar bullish, and it's more bullish for gold than it is for the miners, because in the end, miners are stocks, and stocks are headed lower, in my opinion.
These various dynamics can be quite confusing for people to try to figure out how to position themselves to be in as safe a position as they can be, and also be able to be positioned to participate in potential growth going forward. There's these even when you talk about disinflation and malaise and that sort of thing, people have seen the real estate market starting to soften. There, you can maybe tell us what you're looking at there, but they're still seeing food prices and other medical prices, other things, just showing no end in sight. Can you help us understand those different elements that comprise our financial lives and why they may be pushing in different directions?
Well, first of all, we don't have deflation right now. We had deflation in asset prices, deflation in bond prices, deflation on Wall Street. We don't have deflation. There's a very big difference between disinflation, which is the second derivative change. So look at the latest inflation figures. And prices are rising 6.1% year over year. They fell month over month, marginally, 0.01%. Very marginal decline. But year over year, they're still up 6.1%. So they're rising, but just rising at a slower rate of change. So that's what you're seeing there. As far as home prices are concerned, you're seeing deflation again on Wall Street and asset prices. Home prices are starting to roll over slowly. And look at one of the most important metrics I look in the housing market is the applications for new home purchases. They're down 44% year over year. That's a depression. I mean, how could you possibly have an economic expansion or even increase in home prices when there's a 44% decline in demand for homes? Now you have the other side of the equation is supply. I think supply is coming on the market because don't forget, Blackstone and Wall Street were responsible for about 20 to 25% of all new home purchases in post-pandemic, 2021. So that was a great deal for Wall Street as long as the principal was appreciating, the home prices were going up and you can get rents going higher as well. Well, that's turning around. Now you're finding home prices have topped out. They're starting to roll over. That doesn't look so good on a bank's balance sheet. And also, as we see an uptick in the unemployment rate, which I think will happen, albeit a little less dramatic than it was in 2008, but still an uptick in unemployment, you're going to see rents, at least the occupancy rate for these homes, go down.
You touched on unemployment. Let's dig into that a bit with labor, because that's one thing that just baffles me when we hear about these major layoffs from large companies, large tech companies and other large firms, financial firms, et cetera, laying off tens of thousands of workers, and not just one or two, but lots of these companies making these announcements. And you also know that labor workforce participation rate has been low over the past several years. So the measure, you said you don't trust China's way of stating their numbers, but how about our labor statistic? Can you talk to us about the real state as you see it of the labor market?
All right. So the headline figure shows actually the unemployment rate falls was its high, for the lowest reading in history of the unemployment rate. And then you see a gain, I think it was 226,000 gained in this last report for December. And then you say, well, wait a second. Well, we have other measures of employment, even outside of the BLS. So if you look at the Institute for Supply Management Manufacturing Survey, the economy has two sectors, service sector and the manufacturing sector. The service sector is the largest part of the economy. The service sector actually was shrinking, and the employment subcomponent index was shrinking. That's the largest part of the economy. Not only that, you have the National Federation of Independent Businesses, NFIB survey of small businesses. That was the second lowest reading since 2013, NFIB. And if you have small businesses account for 64% of all new hires. So you have small businesses that are in a depression, and the two sectors of the economy are shrinking, both the manufacturing and the service sector. The largest part, subcomponent, is laying off people. Something's wrong here. But if you look at the BLS survey, you see that the December job growth was the lowest amount of jobs created in the last 2 years. And I look at something called the index of aggregate hours worked. This tells you more information than just how many new jobs were created. Because don't forget, if I have a full-time job and I'm working 8 hours a day, and I lose that job and I replace it with a 4-hour-a-day job and a 3-hour-a-day job, well, I've increased my employment. There's a new one new job has been created, but I'm working less. It's the quality of the job market that the index of aggregate hours work measures, and that has fallen. It fell in December and it fell in November. So it's 2 months in a row of declines. So if you peel back the onion a little bit, you can see that the labor market is not as strong as the headline figures. And even those headline figures are weakening a little bit, and they absolutely fly in the face against other measures of employment like NFIB and like the ISMs.
Historically, there are often revisions to these numbers in retrospect as well, right? So these are already trailing numbers, and then they sometimes get revised. What is there a general pattern to those revisions, or does it can sometimes be up, sometimes down? No particular pattern.
I would listen. I don't know much about the pattern of revisions. There isn't that much of a pattern as far as I'm concerned. I would worry more about the lagged effects of tightening monetary policy. This is what we're seeing right now. We're seeing the beginning tremors of what happened last year. Don't forget, in March of 2022, less than a year ago, we still had a 0% interest rate policy. Rates went from 0, they're going to be 5% by March. They're going to raise again in February 1st, and then again in April. So I think it's March. March. So they'll be 5%. 5%. That is the fastest rate of change in interest rates in history. At the same time that's happening, they're draining the balance sheet. The balance sheet was $9 trillion at its high. And the balance sheet should be close to $8 trillion by the time we get to the spring. If they continue shedding $100 billion a month, $95 billion a month off the balance sheet, it'll be around $8 trillion, maybe a little higher. So the lagged effect, you have to go back and do your research. The lagged effects is about 12 months. So we're not even really there yet. So people say, well, the economy is doing better than expected. Well, there's two parts of what's happening here. The first part of this monetary tightening, global monetary tightening, was the reset of asset prices. See, home prices are starting to roll over now. Stock prices were the first to contract. Bond prices were the first, of course, by definition, they had to contract. Prices down, yields higher. That was part one. That's ongoing. Part two is the lagged monetary effects of this tightening, which are usually about a year. That's what the history shows. So in the spring, all the way through the end of 2023, you're going to see what happened in the spring of 22. The 75 basis points that happened in the summer through the fall. That's going to hit us this year, but in the summer and in the fall, most saliently. So that you're going to see part two. That's going to cause a sharp decline in earnings per share growth. And if you look at fair value on the S&P 500, if you just go back to if you want to say this, I look at the total market cap of equities to GDP to determine the fair value. Now let's just say it's 100%, which is still rich historically, but let's just keep it at 100 because I'm generous. Feel generous this morning. Right now it's at 160. It has to go down to 100%. You're looking at the S&P that probably is going to be around 2,500 from where it is today, which is about 3,900, 3,900. That's a sharp drop. And don't forget, as a recession manifests, the denominator GDP falls. So I'm just trying to be realistic here. The Fed can't come to the rescue as they've done in the past because 6.1%, although it's down from 9.1, 6.5, is down from 9.1, Dunnigan. Guess what? It's still over three times higher than their target. So they can't come to the rescue as fast as they used to. They have to disabuse the market. This is crucial. Powell wants to disabuse the market of its reflex reaction to every hiccup in the stock market or in the economy. This is what engendered inflation near double digits. And the way you measured it accurately was closer to 20%. So Powell's not coming to the rescue. You're going to have a crash in earnings. I think the average decline of the S&P 500 earnings is about 39%. If you take out 2000 and 2008 recessions, you get 19%. So even if we have this soft landing, or no landing, crash landing, I don't know what kind of landing is going to be, but if you take out the last two recessions, 19%, you're talking about earnings that are around $180 a share for the S&P 500. So we're talking about a very, very overvalued market in the context of a great monetary tightening with its lagged effects that is being mollified and offset temporarily by China reopening. I don't think that lasts very long.
So as an active money manager, you are taking care of a lot of accounts for a lot of clients, and you're watching over, trying to protect them, keep them on the right side of these phenomena that are happening. So you've talked to us about your horsemen of the apocalypse, I think, in the past. So what are things that you turn to when you expect this lagged effect to continue to be destructive to equity values going forward? So people who've been told by their money manager, their traditional set it and forget it money managers always said, yeah, just 60-40, you'll be fine, don't worry, just write out the bubs, dollar cost averaging. Those people are getting hurt over the past year, and you're saying you ain't seen nothing yet, folks. We haven't even really seen the full impact of these interest rate increases by the Fed. There's more to come. How do you keep your clients protected and on the right side of the impacts of those changes?
That's one of the reasons why I created the model that I use. So, I mean, the model is clearly telling me that it's not time yet to panic. I mean, when you head for the four horsemen in full grandeur, when you want to be massively net short equities, when you want to be very long the dollar, when you want to be long bonds, both short term and in duration, and want to have cash, only those four things, you have to see high yield spreads blow out. You want to see financial conditions tighten greatly. And I have 18 more components that I can name for you. So right now they're flat. They're in amber, but they're actually getting a little bit better. And I think it's because, China is reopening. And it's like I said, so that the model I created helps me with this timing of when to really push your bets on the short side. So, we took out half of our short position a few months ago. We replaced it with another short that's less, acutely tuned. So I have a short in the portfolio that looks at every sector and shorts the high beta sectors and goes long the low beta sectors. So it's not really I don't really call it a straight short, but it does give you some of a ballast in the portfolio. And you also, I increased my longs recently too a little bit because of what the model's output is. I have to follow the model because it keeps me from being some, ideologue, which I don't want to be. I don't want to be someone who says, the economy is going to crash in the third quarter of 2023, and we're going to be massively net short. Prepare for that. It doesn't help you in Q1 and Q2. And believe me, I have clients that look at the portfolio every single day. So I don't do philosophical investing. So, but as the model, which I predict should get worse as we head throughout the year. In other words, the 10-2 spread begins to become more inverted, and you see the financial conditions index decline, and you look at the high yield spread start to blow out, copper gold ratio do its thing. So then that'll tell me when it's time to get more negative, and I will increase the shorts. I'll sell some more longs. And I'll increase the bond portfolio too.
Before we wrap, I wanted to see if we could touch one more time on what's going on in Japan, because it's been very interesting watching them try to defend these lines in the sand and then retreat from those in terms of 0%, 0.25%, and 0.5%. And you're saying they may just throw in the towel.
I just want to say, I didn't say that's what Bloomberg and the Wall Street Journal says they're contemplating. I can't, to me, I think it's unfathomable, Dunnigan, that you can have a country that has one half of 1% yield going out 10 years in duration. And so, hey, the Bank of Japan doesn't have to print any more money, any more yen and buy bonds any longer. I mean, just think about that. if they did that, the yields wouldn't go from 0.5% to 1. They would go probably to 6 in a few days, if not hours. One bowl of sushi, and they'd be close to double digits. So they can't let that happen, because it would absolutely destroy not only the Japanese economy, but it would suck up. Because don't forget, Japan is the largest participant in treasury auctions in the United States. Well, if I'm a citizen of Japan, I don't have to hedge the currency, I don't have to do anything. I just have to buy a Japanese bond. I'll buy that instead of a treasury. And I might even sell the ones I have to buy JGBs. So you would have a global chaos from such a reaction from the Bank of Japan would be chaotic beyond belief. So I'm waiting for the decision tomorrow. I can't wait to hear it. But I mean, maybe they go up 70 to 75 basis points, but just think about what they're doing there. 25, 50, 75. Don't you think the market is going to press the issue? Because now they're going to say, wait a second, you just went up by 50 basis points in a matter of a few weeks. What's going to happen down the road? Those shorts will come in. They'll short the Japanese bond market, and those yields might go right past their cap, which would again cause them to print a whole heck of a lot of yen. So this is how complex, but how important it is to monitor these global dynamics. That's why I laugh when I hear people say, people in my industry say, oh, we're just going to buy and hold a 60-40 portfolio, blah, 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 blah. Well, that's me. I call these people used carpet salesmen. You're not an economist. You're not a market strategist. You're just someone who wants to take your money and plug and play it into some model that the firm tells you to do, and go on to the next customer. And hopefully, hopefully, they don't have to do much contact with you in the future. That's not going to work today. First of all, buy and hold does not work. There are times in this country where it's been 15 years where it didn't work. In nominal terms and in real terms, it was much worse. In Japan, it hasn't worked since '89, and in China, it hasn't worked since 2007. So yes, buy and hold does not work. You have to understand what asset classes, what style factors, what sectors to own in each economic regime between deflation and depression and hyperinflation. You should understand that. You should have a model that measures that and invest accordingly.
If people want to stay closer connected to your work, or if they want you to actively manage any portion of their funds, how could they get connected with you?
The website is www.pentoport.com. My email address is mpento@pentoport.com. You can call the office here, 732-772-9500. That's the Jersey address. We have a number here in Naples, where I just moved to recently, in Florida. But that number I just gave you will get you to either office. And I'll take care of you. If you have about $100,000 to invest, you're a U.S. citizen, be happy to help you navigate these rough waters. Of course, I have a podcast called the Midweek Reality Check for $50 a year. And that'll give you more insights into the kind of real data that you need to understand to get a better idea of where we are in the economy, in the G3 nations, China, Europe, and the United States. And if you can understand that, you'll have a better idea than putting your money with a wirehouse and just hoping things work out for the best in the long run. Because if I'll leave you with this: if you're massively long bonds and bond proxies in intractable inflation, you're gonna get crushed. And if you're massively long high beta risk assets in deflation and recession, depression, you're gonna lose. Your retirement is gonna be thrown into the fire. So it's very crucial you understand these dynamics, get them right, and I think what I do here gives you the best chance to achieve that goal.
We've been speaking with Michael Pento, the founder and owner of Pento Portfolio Strategies. He can be found at pentoport.com. And folks, if you don't want to miss a single interview with Michael or any of our guests, make sure you go to libertyandfinance.com, put in your name, your email address, click submit, make sure you confirm on the confirming email, and you're in for free. And you get one email in your inbox per day with our latest guest and any weekly specials. And as always, on behalf of our viewers, Michael, we thank you for joining us here on Liberty and Finance.
Hope you feel better, Dunnigan, and thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.